When investors talk about risk, they only usually refer to volatility. I'll show you some other risks you should be aware of as an investor if you want to succeed during your investment journey. Welcome to another episode of Money Matters. Let's start with the one risk that everybody knows already. Imagine that I own stocks in Apple. Imagine also that the world is experiencing a major economic slowdown and people are no longer spending. Apple's earnings figures takes a huge drop and as a consequence their share price falls. Thus, my Apple stock has suffered from negative volatility from external market factors. Imagine this next example as well. Apple, through a series of management blunders, have been releasing uncompetitive products and their competitors have been slowly taking a greater market share of the market. As a consequence, their earnings have been falling and their share price keeps dropping. Again, my Apple stock has suffered from negative volatility, but this time from internal factors. As investors, when we buy stock, we buy on the expectation that the external and internal factors are favorable and we experience positive volatility and thus we benefit from returns from our investment choices. Let's talk about another form of risk. Imagine that an individual does not know about investment and simply holds on to cash. He is saving his money and the cash continues to build. His plan is that he will eventually retire due to old age and he should have saved enough cash to live out the rest of his life until death. There are several risks I want to point out here. First, the cost of living increases over time. Just think about petrol prices increasing or the cost of food increasing. However, the money he has likely saved in the bank account is unlikely able to generate enough interest from the bank to keep up with inflation. We can see here the inflation rate in Hong Kong over the past 25 years. And you can see that for many years, interest rates haven't been able to keep up with inflation, which means that by hoarding cash in the bank, it is losing value in real terms. This is called inflation risk. Another risk in this scenario relates to his objective of building up enough wealth so that he can retire in old age. How much cash he needs in retirement depends on his lifestyle and how much it costs to support it. And it also depends on how many years he will continue to live out until he dies. Let's say he has established the target he needs to reach before he retires. But because he is not generating any market returns as he is holding cash, he may not achieve his target. This is called shortfall risk. He will either have to continue to work and continue saving or adjust his retirement lifestyle to account for the shortfall or simply run out of cash before his death. Shortfall risk also applies to someone who has invested into the markets but is too cautious in his approach. So although he is benefiting from lower levels of volatility, he may not achieve his investment objective and thus has a shortfall. It is also important to understand the risk versus reward relationship and the need to take on enough risk in order to achieve your investment objective. Coming back to the example of the cash hoarder, he will benefit from interest from the bank for saving cash. However, he has little to no control over the amount of interest he is going to get from the bank. The most he can realistically do is to choose another bank that offers a better rate and opt for a time deposit account that pays him better rates. When he reaches retirement, because all his wealth is in cash, his retirement planning is at the mercy of the interest rate from the bank. The variance in interest rates is called interest rate risk. In the topic of bonds versus stocks, bonds are deemed as less risky than stocks, and one of the main reasons is that bondholders will get the money back before shareholders in the event of insolvency of a company. However, it is also the case that a company may default on their bond obligations regardless of insolvency. This is called default risk. The historical annual default rate for high-yield bonds is around 5%. When buying stocks, you can opt to buy the stock of small or large companies, which is commonly referred to as small cap, mid cap, large cap, and mega cap. There is some evidence to suggest that small cap stocks deliver better returns than stocks of larger companies. However, it is also regarded that larger firms may be better able to weather economic downturns, whereas small companies suffer liquidity issues as they may have little cash on hand. This is called liquidity risk. Liquidity risk also refers to an investor holding too many illiquid assets, such as property or some types of alternative assets, or simply not holding enough cash for emergencies. Another factor to consider for stock pickers is that they may only be picking a small handful of stocks. This investment strategy relies on extremely high levels of due diligence to ensure that companies they have picked are good picks relevant to the current market conditions. These high conviction portfolios are subject to concentration risk, and this also relates to portfolios that are reliant on any one particular sector or one particular economy to perform. Diversification is the term we use to deal with this form of risk, and hence why we call it not putting all your eggs in one basket. These are just a few examples of risks that an average investor must consider when constructing their portfolio. It takes a lot of time during the construction process and ongoing management to ensure continued performance. Risk has to be put into context. Therefore, it is crucial to understand your investment objective and to set a target. That way, the risks are contextualized and easier to understand. Thank you for joining me on this episode of Money Matters. Ask me a question about your portfolio in the comments below. Let me know what other topics you would like to hear about in future videos. Smash that like button, subscribe, and I'll see you in the next episode of Money Matters.